Hello and welcome to Trading Nation. I'm Brian Sullivan. We're pleased to be joined today by David Rosenberg, Chief Economist and Strategist at Gluskin Sheff. And David's brought along 5 reasons why he's not fearful, but definitely has his flags, or sort of the radar is up on this market. David, before we get into your 5 reasons, how would you best describe your view on the overall U.S. stock market right now?
Well, I think that this faith-based rally is overdone. Probably can get extended into the new year because the reality is that with everybody thinking that their tax rate is going to be lower in 2017, the big story is that there just aren't any sellers at the most seasonally positive time of the year. But when you talk to me about the critical part here is the extreme levels of valuations and the earnings growth that's embedded in stock market valuations right now are just a little too extreme for me.
Okay, and you've got some worries, and I want to sort of bounce around your own list, because I was in Washington, D.C. on Monday, and we had both on-air interviews and I had off-the-air meetings. And the one thing I came away with, and I said this on the show Power Lunch, was just because it's a GOP sweep doesn't mean things are going to be easy. You still need 60 Democrats for most, or 60 votes for most things, which means 6 or 7 Democrats in the Senate have to come on board. In other words, it's very unlikely that everything that is being promised is going to happen, even with the GOP sweep. Why is that a worry for you as well?
Well, I would just say that it comes down to what's being priced in. When I finally put my head on the pillow in the wee hours of the morning on November the 9th, and you saw what futures were doing, obviously it was probably like on 3 or 4 trades, but I put up my initial report, which is that if the market melts down because of a Trump victory, you want to buy that sell-off. And here we've had a complete reversal. And I think that people are just, really reaching here in terms of what one man can really accomplish. And it's not just, the 60 seats in the Senate really to avoid filibuster and do anything big. There's other stuff he could do on his own, including deregulation. But the extent of this rally right now, I mean, you have to have a view that earnings growth is going to be at least 30% in the next year. Like, you got 3 or 4 years of earnings growth already priced into the market. So you have to be making a bet here that all the good stuff that Trump's going to do, all of it's going to get in, and it's going to get in quickly, and none of the bad stuff is going to show up. So I just think that's a low odds bet that the markets are putting down right now.
I think and everybody's got slightly different numbers. If I look at sort of just the FactSet or Capital IQ, some of these data provider numbers, I think the S&P is at about 22 to 24 times trailing earnings, 18 to 18.5 forward earnings. Are those fair valuations? Are those even the numbers you have?
Well, they're not fair value. Well, I think that you can't even use the crux anymore of low interest rates, since we've had a over 100 basis point backup in very short order. My sense is that if you were to have some sort of mean reversion on the forward multiple, you'd be closer to 15.5 to 16 than 18.5 plus. And so, even benchmarked against the most optimistic earnings scenario, your fair value on the S&P 500 is closer to 1950, than it is to 2200 plus. So, look, the market's been overextended for a while. We've just taken a very big leg up here. By the way, it's not unusual to have the markets rip, between election day and inauguration day. It happens most of the time. And so nothing here should be altogether that surprising. The levels of, I think, sentiment, the levels of market positioning, and the levels of valuation, especially at this stage of the cycle, do have me a little bit worried that if we see any disappointment at all, it could lead to the sort of a pullback we had, you remember, heading into January last year.
We know optimism is up, the stock market is up. Is the economy up as much?
Well, not nearly. I mean, right now, this is all being premised on a lot of perception, hypothetical, and expectations of what Donald Trump is going to be able to generate. So, no, there's nothing in the economy. I think the economy generally is doing okay, but, we haven't seen the full brunt yet of what's been a 70 basis point backup in mortgage rates. And it's not because housing demand has all of a sudden taken a big leap up. It's really because of this exogenous bond market sell-off. Mortgage rates are up 70 basis points. That's going to have an impact on housing into the opening months of the year. And the dollar's move over the course of the past 5-6 weeks is equivalent to almost 2 Fed rate hikes right there. And we already saw in October the impact that had on export volumes and the trade deficit. And I think that's going to be the thin edge of the wedge. So before anything even gets done from a fiscal a regulatory standpoint, we're going to have the tighten effects from the mortgage market, from the dollar, hitting growth in the opening months of next year, and that could affect market sentiment as well. You know, once we get past this period where sellers finally at some point are going to emerge into this market and take some profits.
And what's your just sort of early prediction for the first half of 2017, if you have one, David?
Well, you know, it's almost like we have to take it almost a month at a time. Look at the wild roller coaster ride we had in 2016. We're going to have, I think, even a more, I would say, acute volatility with wide fluctuations, and we're going to have to actually be very nimble and almost put our trader's hat on for 2017. I mean, this is good news for us because I think it means active management finally is going to be trumping, pardon the pun, passive management. But my sense is that, you know, beyond, once we get past Inauguration Day, you know, the honeymoon period ends. And we all know that once the honeymoon ends, the hard work begins. But you have a lot priced in at this stage. And so I think it's really, you know, once we go into the opening weeks of next year, a one-sided market, I would not at all be surprised that we get repeated pullbacks along the way from where we are right now. I think those pullbacks are going to create some opportunities. So I think that if you're prepared for the volatility and you have more cash on hand than you normally do, the coming year could actually be quite profitable, but you have to be willing to trade the market a lot more than you have in the past.
All right, could be a very interesting year. I know it's been a very interesting end to this year as well. And David, we appreciate you joining us. We hope to see you again here soon on Trading Nation. Thank you.
Thanks.
David Rosenberg of Gluskin. Sheff, folks, thank you for tuning in. We'll see you next time. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.